Hi guys, how's it going? My name's John, and I'm doing a basic video on just understanding the basics of investing. Um, just a little bit of my background. I've been working in financial services for at least 20 years. I've also, on a personal level, got training experience with IT training and um, helping friends and family with investing, but also personally training people on the basics of investing and how to actually get confidence to start investing and actually get a return on their investments. There's a lot of jargon and a lot of complications and conflicting information, and it makes it quite daunting sometimes to um, make that step and actually start doing it. I think there's around only about 6% of the UK population actually invest, which is a tiny population. And the truth is that if you're leaving your money in bank savings accounts, you can get a few high interest accounts, but a lot of accounts are only 1 or 2% interest, which is very low, and you can potentially get a lot more from that investing. And um, it's safe as well in the UK. The FSA, covers you up to at least 80k for general investing and more in some cases. So anyway, I'm just running through some basics. So please watch on until the end, and I'd be very interested to have any of your questions. This is quite a new thing for me. I love the YouTube platform, and I follow a number of people, and I've always been keen to create some videos and hopefully help some people. So please follow on. Just one um, message that this is not financial advice. This is just my own opinions and thoughts. So let's go. So understanding the basics of investing. What is investing? So investing means committing money to an asset or a venture and expecting an income or capital gain. So in simple terms, you find a company that you like, for example, Lloyd's in the UK or Apple in the US, and you want to invest into that company. You would buy certain amount of shares, and these days you can buy fractional shares, so you can buy very small bits of a share as well. So you buy shares in that company. Um, the goal of investing is just to make money, to build wealth um, through decisions, basically. How investing differs from savings. Savings aims to just preserve your money with very minimal risk, using very low risk accounts and instruments. Just means they put it somewhere safe. The bank may actually invest your savings and make more money out of it than you do. So they might pay you 2% interest, but actually, they're investing all of this money and they're making much more back on that um, investing approach. Invest involves accepting some risk. So you have to accept some risk to get reward. So a standard savings account is very safe. There's hardly any risk and there's very low reward. Um, and growth potential, investing can grow funds beyond typical returns. So you can potentially grow your wealth a lot quicker investing in the stock market. And there's something called compounding, which means that all dividends, which I'll talk about later, but any interest, you can compound that interest into your investment and that will grow and grow and grow exponentially. Um, so simple investing. So investing versus saving. Investing aims for higher returns by accepting more risk, as I said. Investing potentially offers higher long-term returns. Savings typically yield lower, more stable gains. So savings are very safe, but if you've got a large amount of money to invest, you can make massive potential gains through investing in stock market rather than just in a savings account. Another subject is also premium bonds, which I'm personally not that keen on, but I'll talk about that at another time. investing generally suits longer time horizons. Savings is better for short-term financial goals. So if you just want to put the money aside for a short time while you're going to spend it on an extension or buying a car, you might just put it in a savings account. The benefits and the reasons to invest. So the potential for wealth growth. Investing wisely maximizes the potential, means that if you invest wisely, and this doesn't take a lot of previous knowledge. I've talked about it in a lot more detail as we go on, but you can invest in funds, which means a fund manager has chosen particular stocks and you invest into that fund. And that means that you're relying on the fund manager's ability to pick good stocks. So it's not all about just picking one stock and hoping for the best. There's a lot safer measured approaches for this, which I'll talk about. As I was saying, compound growth means returns generate additional returns, increasing wealth exponentially. Long-term benefits. You can have significant money growth over time. This also helps against inflation. So investing allows your money to grow faster than inflation, protecting your purchasing power. And savings alone won't keep up with inflation. Financial goals. Everyone's got financial goals. You might just be thinking about retirement planning. You might not have a big pension, or you want to save and invest separately, which I do. So you've got a separate pot that you can grow. You might want to be growing or saving for a home purchase or education and financing. I'm putting money aside. My kids have got stocks and shares ISAs, which I'm putting money aside, which will either be for education or in the long term for probably property. The risks. So market volatility and losses. Excuse me. So there's a few things which can cause volatility. So market sentiment, economic conditions, and unforeseen events. For example, like wars. Wars are not good for stability in the stock market because there's more concern about what's going to happen. Same with Trump applying his tariffs. It's a bit of an unknown about what he's going to do next, so which causes concern. Traders and bankers and risk management don't like wars or any sort of instability. Volatility can result in both temporary and permanent investment losses. So you've got to be prepared to potentially lose some of your money. So a stock obviously can go up, but stock can go down. So that's volatility. In the long term, stocks will go up. I think there's a statistic, don't quote me on this, but in any 7-year period, the S&P 500, which is the top 500 companies in America, has always gone up. So as long as you hold that fund for 7 years, you will have beaten inflation and it would have gone up. But I'll go into this in a lot more detail. If anything sounds weird to you or you don't know what I'm talking about, please put it in the comments and I will break it down. I'm trying to make it as simple as possible and help people understand because it's not scary and it's very easy once you get past the basics. So losses from market volatility can be temporary. So for COVID, when COVID went down, a lot of the stock market went down crazily, but a lot of people panic and sell their stocks. But another view of this is it's an opportunity. You don't get many opportunities where the stock market drops by 20%. That's a massive opportunity. So a lot of people are panic selling, but a lot of people like me were buying stocks and shares at that time as that's potential for growth, and it's bounced back now. So there's economic and company specific risks. Recessions, inflation can all have an impact, but it also impacts your savings account. So you might have emails as the Bank of England has dropped interest rates. You might have had emails saying your savings interest rates are going down. That's the same. Risk versus reward. So this sometimes people struggle to understand, but get a larger reward, you sometimes have to take some risk. So this chart represents the trade-off between risk and potential reward. So the heavy rock shows that taking on risk can feel heavy and cause potential loss, but the gold coin represents the potential for a larger, more valuable return. So you're risking a bit with the stone, and there's potential to get a big gold coin in the reward. And different investments are positioned on the chart according to different choices. So you can take a lot of different levels of risk. I've done a lot of different types of investing through forex, crypto, just stocks and shares. I've done all right in some cases, and I've made some mistakes, and it's all part of the learning curve, I think, which makes you into a more confident and better investor in the long term. Excuse me. Where to invest? So you can invest with banks. Banks have a lot of investment services, and they do personalised financial advice, etc. But I find that a lot of the times they're obviously want you to buy their products and don't try any other bank or any other product. Sometimes there's higher fees associated with this, which are consumed within the product that you're bought into, which sometimes you might not understand or might not realise. Sometimes the in-person guidance is more attractive. So if you're the older generation, like my mum and other people that I've helped, sometimes just stick with the bank because they think that's the safest option. And sometimes it is the safest option, but it's not the best option for returns, and the fees and the return you get is much lower than some private other companies that you can use. Other providers, for example, Trading 212 and Hargreaves and Lansdown, they offer easy access. They've got competitive fees. They're very user friendly and have beginner oriented tools. I'm going to do some further videos on how to use Trading 212. It's super simple, and there's a lot of options in there where you can use pies, where you can buy fractional shares. It's really interesting and really easy. So that's going to be in a future video. Trading fees. So you can get quite different fees depending on what platform and what product and what you use, basically. There's a big difference. I find Trading 212 really good. Some of the banks actually have quite big fees on some of their products, which some people don't realize, but I'll go into this in some future videos. For the minute, I'm just trying to give people just a basic overview. I'm going to go into some more detailed information and key investment types. So I talked about this earlier, but I'll just go into it again. So stocks represent the ownership and stake in a company. So it offers growth potential but carries higher risk as you're just buying into that one stock. Bonds and loans are entities providing regular interest payments and generally involve lower risk than stocks. So you can buy into bonds, and bonds might include separate stocks or funds. ETFs and mutual funds. So ETF is exchange traded fund. So it's a fund that could have many different stocks in it, as I was discussing earlier. So there's hundreds of ETF products out there, and that is a safer option to start with. There's a very common one which you might hear about, which includes the S&P 500. So that is the top 500 companies in the US, and that changes. Some people don't understand that the S&P 500 is constantly changing based on what is referred to as the top 500 companies, and this could be their how well that company is performing. You can have diversified asset holdings. These funds invest in a mix of stocks, bonds, and other assets to offer a broad market exposure and risk diversification. So as I was saying, that sort of mitigates your risk and makes it a lot safer than buying one stock. What I tend to do is buy into some funds and have some separate stocks, but I'll go into this later. It just makes it easier to diversify. There's also commodities and property investing. So commodities like gold, oil, silver, you can invest in them and have a good broader spectrum in your portfolio. But a lot of the time, if the stock market is struggling, people buy into commodities like gold, as this is a stable investment, and you can easily do this as part of your portfolio in Trading 212, which I will show you at a later date. You can also invest in property, and there is funds which include property investments. So getting started. So I would always suggest starting with small amounts. This will manage your risk, and as you get more experience, you can gradually increase as soon as your confidence builds. But as I say, it's very, very straightforward once you get the basics. Diversification helps minimize your risk, spreading investments across different asset types and sectors, as I discussed. So you could buy Apple, you could buy Lloyd's, and you could buy gold as an example and spread that in one pie in Trading 212, which means you can add lots of different assets in one pie. It's really cool, and it's very simple to do once you get the basics, which I will show you in a later video. Regular investments, consistently monthly, helps take advantage of market ups and downs. So there's even something called dollar cost averaging, which means that you invest a tiny bit every day, which means that over time the up and down of the stocks get flattened out because you're investing when it's up and it's down and it's up and it's down. Even if you do it monthly or weekly, that can make a big difference and give you a steady growth in your portfolio. I think if you're watching this, you've got motivation to invest. It's just a path to financial freedom and financial growth and achieve financial independence. I think, don't be the part of the 94% of people in the UK especially that don't invest in the stock market. They've got all their money in savings, in a savings account in a bank, getting 1 or 2%. You could be getting 10 times that if you were well placed in the stock market, and mitigating not too much risk. So just as a conclusion, investing is basically the key to improving personal wealth over time. I'm just trying to help you understand investing basics. As I was saying, especially for the aged older population, I've done a lot of IT training and investing help with family, friends, and I personally have got a lot of investing experience over time, and I just want to help other people, and I hope this video can help them. I'm trying to give beginners confidence, and in future videos I'll go through how to use Trading 212, how to set up your account, and a lot of the specifics and how to get started. If anyone can leave any comments, if you've got anything in particular you'd like me to cover, of course, investing, different products, the risks, crypto. I've also done using AI now. I've also set up Python scripts which are created from AI, which query Yahoo Finance and rank stocks in different sectors or countries. So I like getting into the technical stuff as well. So that's all for the future. So please leave a comment and like and subscribe. It would help me so much just to get started. Much appreciated. Thanks.